Welcome to the retirement chapter. Let's begin with the research question from chapter 6. Jennifer, age 39, had 3 traditional IRAs with Bank of Your City. She decided to take an entire distribution from IRA number 1 on June 1st. On July 15th, she deposited the full amount in a new traditional IRA at State Bank. In August, she decided that she wanted to close IRA number 2 at Bank of Your City, planning to redeposit the funds in a new traditional IRA at Citi Savings and Loan. Can she take an entire distribution from IRA number 2 on August 15th and deposit the full amount in a new traditional IRA at Citi Savings and Loan on September 3rd? What do you think? Is it a yes or a no? Jump on the pause button and hop up and down until you're ready to resume for the correct answer. If you answered no, you are correct. If Jennifer takes a distribution from IRA number 2, she may not redeposit the funds into a third IRA within the 1-year period that begins June 1st. However, Jennifer may arrange a trustee-to-trustee transfer from IRA number 2 to IRA number 3 at any time. The answer to this question can be found on page 84 in Publication 17 under the heading, Waiting Period Between Rollovers. Let's look at our objectives for today. In this video, we will discuss the topic of retirement. By the end of this chapter, you'll be able to assess a taxpayer's information and circumstances to determine whether they are eligible to contribute to a traditional or Roth IRA. Calculate the deductible amount of a taxpayer's traditional IRA contribution. Identify and report qualified retirement plan distributions. Recognize and calculate taxable IRA distributions. Determine the tax treatment of early distributions from IRAs and other qualified retirement plans. Identify exceptions to the additional tax on early distributions. Recognize and calculate the retirement savings contributions credit. Calculate and report the taxable portion of a taxpayer's Social Security or Tier 1 railroad retirement benefits. Let's begin our chat with employer-sponsored retirement plans. One common way to save for retirement is through an employer-sponsored plan. Employer-sponsored retirement plans can be in the form of a qualified or a non-qualified plan. Let's talk about some of the tax benefits that come with retirement plans, starting with qualified plans. So, one big advantage for employers is that they can deduct the contributions they make to these plans for their employees. That's a nice tax break for the company. Now, for employees, the money that goes into the plan, along with any investment earnings, isn't taxed right away. Instead, it grows tax-deferred, meaning you don't pay taxes on it until you start taking withdrawals, usually in retirement. And in some cases, you can even roll that money into another type of IRA and delay taxes even longer. Now let's switch gears and look at non-qualified plans. These are a bit different. They're usually funded with after-tax dollars, so you've already paid taxes on the money going in. But the good news is, any earnings on those contributions can still grow tax-deferred. Non-qualified plans are typically designed for executives or key employees. They're not subject to the same non-discrimination rules that qualified plans have to follow, which gives employers more flexibility. And here's a big plus. Employees can often contribute a larger percentage of their income compared to what's allowed in a qualified plan. So, both types of plans have their own set of tax advantages, depending on your role and your financial goals. Let's look at the different types of qualified plans. When it comes to qualified retirement plans, there are 2 main types: defined benefit plans and defined contribution plans. Let's start with defined benefit plans. These are the traditional ones like pensions. With this type of plan, the employer promises to pay you a specific amount in retirement. That amount is usually based on your age, how many years you've worked, and your salary history with the company. Another example is an annuity. This is a contract where you receive regular payments, typically over a period of more than 1 year, once you retire. Now, let's talk about defined contribution plans, also known as deferred compensation plans. These are funded by contributions from you, your employer, or both, and the money goes into a retirement account before taxes are taken out. The contributions and any investment earnings grow tax-deferred until you withdraw the money. Some common types of defined contribution plans include 401ks, 403bs, and 457 plans. Technically, 403b and 457 plans aren't classified as qualified plans but they work in very similar ways. The benefits of defined contribution plans are pretty appealing. Your contributions are tax-deferred, your earnings grow tax-deferred, and if you're in a 401k plan, your employer might even match a portion of what you contribute, which is essentially free money for your future. Let's do a check for understanding question. Which of the following is an example of a defined contribution plan? A pension that pays benefits based on a fixed formula. An annuity purchased from a life insurance company. A 401k plan. Social Security benefits. What do you think? Pause if you need a minute, then resume when you are ready. Did you say C was correct? You rule. A 401k plan is correct. Generally, employees can make tax-deferred contributions to 401k plans. In addition, many plans have employer matching amounts. Why are these other answers incorrect? Let's take a look. A pension that pays benefits based on a fixed formula is incorrect because pensions based on fixed formulas such as the number of years worked, age, and the taxpayer's history of earnings are defined benefit plans, not defined contribution plans. An annuity purchased from a life insurance company is incorrect because an annuity purchased from a life insurance company is an example of a defined benefit plan. Social Security benefits is incorrect because Social Security benefits are not qualified plans. They are taxed under different rules from other retirement income. Thanks for your participation. Are there contribution limits for these plans? Let's look at contribution limits and find out. Taking advantage of any employer match is a great way to save for retirement and receive free retirement funds from their employer. The maximum annual allowable contribution for deferred compensation plans for 2024 is $23,000. Taxpayers aged 50 and older are allowed an additional annual catch-up contribution of $7,500, bringing their maximum allowable contribution to $30,500. Form W-2 easily identifies deferred contributions, such as 401k or 403b plans, using a variety of codes entered in Box 12. When a taxpayer or spouse participates in their employer-sponsored retirement plan, the retirement plan box in Box 13 on Form W-2 is marked, and this shows they're an active participant. If Box 13 is not marked, then the taxpayer or spouse is not an active participant. A taxpayer's IRA contribution deduction may be limited or disallowed based on their modified AGI, also called MAGI, and whether or not they were an active participant in an employer-sponsored retirement plan. MAGI limits the amount the taxpayer may deduct as an adjustment, but not the amount a taxpayer may contribute to a traditional IRA. Now that we've discussed employer-sponsored plans, let's take a look at IRAs. IRA stands for Individual Retirement Arrangement or Account. A contribution is when a taxpayer puts money into an IRA, and a distribution is when a taxpayer takes money out of an IRA. The IRA contribution limit for 2024 is the lesser of 100% of the taxpayer's compensation, or $7,000. Individuals who have reached age 50 by the end of the year may contribute an additional $1,000 for a total of $8,000. A taxpayer's total combined traditional and Roth IRA contributions cannot exceed $7,000 or $8,000 age 50 or older. So, a taxpayer would have to split the maximum contribution limit between both accounts. Taxpayers like traditional IRAs because their contributions may be deducted from their total income and their contributions are not taxed until they are distributed. To contribute to a traditional IRA, there are a couple of key things to keep in mind. First, you need to have earned income during the year. That means wages, salary, tips, or other compensation from working. Investment income doesn't count. Second, you have to make your contribution by the tax filing deadline, usually April 15th, and that deadline doesn't include any extensions you might file for your return. So even if you get more time to file your taxes, the IRA contribution still has to be in by the original due date. IRAs are also great because a taxpayer may receive an IRA deduction for a 2024 contribution to their traditional IRA made after December 31st, 2024, but on or before April 15th, 2025. There is no minimum or maximum age for contributing to a traditional IRA. Another great thing about traditional IRAs is that a taxpayer can make contributions for themselves or on behalf of their spouse if filing a joint return. What about phase-out ranges? Take a look at this chart. These are the phase-out ranges for each filing status. The phase-out range for a married filing separate taxpayer depends on whether or not they lived with their spouse at any point during the year. A taxpayer is allowed a full deduction for a traditional IRA contribution if their MAGI is less than the first number in each range. If their MAGI is greater than or equal to the first number but less than or equal to the second number in each range, a portion of their deduction is phased out. If their MAGI is greater than the second number, no deduction is allowed. Besides traditional IRAs, what is the other type of IRA available to most individuals? I'll give you a hint. It's Roth IRAs. Roth IRA contributions are not deductible, but Roth IRA distributions may be exempt from tax if qualifications are met. This means that the money earned inside the Roth IRA is usually tax-free. Roth IRAs are pretty similar to traditional IRAs in a few key ways. First, just like with a traditional IRA, you need to have earned income or compensation in order to make a contribution. Second, the deadline to contribute is the same. You have until the tax filing deadline, usually April 15th, and that doesn't include any extensions you might file for your return. Third, there is no age limit for making contributions to the Roth IRA. Now, here's where Roth IRAs offer a bit more flexibility. You're not required to take money out at any specific age, so you can leave your contributions in the account for as long as you want. Roth IRA contributions may phase out if the taxpayer's MAGI is too high. This phase-out range applies whether or not the taxpayer or spouse is an active participant. The Roth IRA MAGI phase-out ranges are provided on the slide and in your participant's guide. The phase-out range for a married filing separate taxpayer again depends on whether or not they lived with their spouse at any point during the year. Many taxpayers whose traditional IRA deduction is reduced due to their MAGI can contribute to both their Roth IRA and traditional IRA, assuming their Roth IRA contribution is not limited by their MAGI. That way, the taxpayer may contribute the maximum $7,000, $8,000 if age 50 or older. Let's answer our third check for understanding question. The maximum IRA contribution for a taxpayer under age 50 is $7,000, $8,000, $23,000, $30,500. What do you say? Pause if you need a minute, then resume. Did you say A is correct? Celebrate yourself. The maximum is $7,000. In addition, if the taxpayer contributes to both a traditional IRA and a Roth IRA, the combined contribution may not exceed this amount. Let's break down why these other answers are incorrect. $8,000 is incorrect because this is the maximum contribution that applies to taxpayers who are age 50 or over. $23,000 is incorrect because this is the maximum amount of compensation that may be deferred under an employer-sponsored deferred compensation plan for taxpayers under age 50. $30,500 is incorrect because this is the maximum amount of compensation that may be deferred under an employer-sponsored deferred compensation plan for taxpayers age 50 or older. Rock on Rockstar. Now that we've talked about contributions to retirement plans, what is it called when a taxpayer takes or receives money from a retirement account? It's a distribution. A non-taxable distribution will generally not affect a taxpayer's tax liability. For distributions that are not non-taxable, what are the two ways that the distribution can be treated? A distribution is either partly taxable or fully taxable. What is a fully taxable distribution? It is a distribution in which the taxpayer did not make any after-tax contributions. All of the contributions were made with money that was not taxed pre-tax, and all the growth has not been taxed. Therefore, when any distribution is made, it is all taxable. Whereas a fully taxable distribution entered on the tax return. The amount received should be entered on Form 1040 or Form 1040-SR, line 5B. No entry is made on line 5A. Here in this example, we can see a fully taxable distribution. This example is under fully taxable distributions, on the non-IRA taxable distributions page of the Participants Guide. What is a partly taxable distribution? A distribution in which the taxpayer has made after-tax contributions to the retirement account. When the taxpayer receives a distribution from this account, a portion of the distribution represents a non-taxable return of their after-tax contribution. Again, the amount they already paid tax on is not taxed a second time. What is the cost basis? The amount of any after-tax contributions. When the basis is distributed, it is not taxed. Can the basis or the after-tax contributions be taken before any pre-tax contributions or growth? For example, Mindy contributed $2,000 in after-tax contributions and $5,000 in pre-tax contributions. After the account has grown to $20,000, can she assume the first $2,000 is the after-tax contributions when she takes a $10,000 distribution? No. Mindy has to determine how much of the distribution is recovery of her basis and how much was pre-tax contributions and growth. This leads to the final two question marks. What are the two methods available for computing the taxable amount of a partially taxable distribution? The simplified method and the general rule. What is the general rule? The general rule is used for calculating the excludable portion of pension and annuity payments if a taxpayer started receiving payments before November 19, 1996. It is only mentioned as a general awareness topic. It is rather complex and would need more research if the taxpayer started receiving their payments before 1996 and wanted or needed to use the general rule. The simplified method is required for most TIEs payers. It is optional for pensions or annuities with a start date after July 1, 1986 and before November 19, 1996. When does it become required? When the pension or annuity starting date is after November 18, 1996. What are the three requirements? These can be found on the non-IRA taxable distributions page of the Participants Guide under Simplified Method. The payments must be from a qualified pension, profit sharing, or stock bonus plan, a qualified employee annuity plan, or a tax-sheltered annuity for 03B plan. The annuitant, the receiver of the payments, must be under 75 years of age when the payments begin, or if 75 or older, there must be fewer than 5 years of guaranteed payments. The payments are for either the annuitant's life or the joint life of the annuitant and a beneficiary. This is much simpler than the general rule. Payments are calculated using a simple table provided on the Simplified Method worksheet. We'll look at an example of the simplified method in a little while. For now, on what form are retirement distributions reported to the taxpayer? Form 1099-R. What is the difference between Box 1 and Box 2A? Box 1 reports the gross distribution the taxpayer received throughout the year. Box 2A is the amount of the gross distribution that is taxable. Will these two amounts always be the same? No. They could be the same, or they could be very different amounts. Can you give me an example of when Box 2A will be less than Box 1? Answers may vary. Normally, this occurs when some of the contributions were made with after-tax dollars. What is an after-tax contribution? It is a contribution that is made with money that has already been taxed. Since it was taxed when it was contributed, it is not taxed again when it is distributed to the taxpayer. Let's look at an example. For example, if Mindy made 5% contributions to her 401k with part of her salary that has not been taxed, she is making a 5% pre-tax contribution. If she also contributes an additional 2% to her 401k with part of her salary that has been taxed, she is making a 2% after-tax contribution. If her salary is $100,000, then her 5% pre-tax contribution would be $5,000. Her 2% after-tax contribution would be $2,000. This totals $7,000 in contributions. If she has a total distribution 30 years later, the original $2,000 she contributed after tax would not be taxed again. This would make Box 2 $2,000, less than Box 1. All of the growth that resulted from that $2,000 after-tax contribution would be taxable since all of the growth had been tax deferred. What information is provided in Box 7? Distribution codes. The codes identify the type of distribution the taxpayer has. Why would it be important to identify the type of distribution? Some distributions can result in an additional 10% tax. Other distributions qualify for exceptions to the 10% additional tax. Some other distributions, such as rollovers, might not be taxable at all. Let's brainstorm together. What are some of the types of distributions you can remember that have their own codes? Don't worry about the code number, just the types of distributions. Pause to think about it, then resume when you are ready. I'm thinking about it too. Answers may include the following codes listed in the Retirement Account Distributions page of the Participants Guide. Early distribution with no known exceptions. Early distribution with an exception, disability, death. Normal distribution. Direct rollover to a qualified retirement plan. Early distribution from a Roth IRA with no known exceptions. Qualified distribution from a Roth IRA. Roth IRA distribution due to death or disability. Let's talk about IRA distributions after our next check for understanding question.